Good evening, everyone. Am I audible now? Wait, let me just open it now. Just give me 1 minute, then we are starting off. Yes, I believe I'm very much clear and audible now. Open it now. Just give me 1 minute, then we are starting off. Yes, perfect. Good evening, everyone. I hope you're all doing good. Please send me a hi in the chat box so as to confirm that I'm audible to all of you. Yes, friends, hope you're all doing good. Welcome to this intensive theory marathon. First of all, apologies for the earlier session. Exactly at 8 o'clock, I lost my connectivity. Nothing could be done. I'm sitting and checking, trying to call the helpline. Nobody is picking up the call. Finally, I got it sorted now, and I think I don't have to waste any further time of yours. We can quickly start off with today's session. If you're all ready, please type ready in the chat box, friends. Please type ready in the chat box. Yes, good evening, everyone. Good evening, Siddharth. Good evening, Sarvamangla. Hope you're doing good. Good evening, Kartika, Meenakshi, Jagan, Rasika, Anila. Good evening, everyone. Good evening, Sanika, Prajita. Okay, everyone ready now? Fantastic, fantastic, fantastic. So I think everything is absolutely clear. My video is clear. My audio is also clear. There is no other complications. So friends, let us quickly start off with today's theory marathon. So friends, there are multiple chapters in AFM which is having theory. So basically there are some exclusive theory chapters such as mutual funds is there, mergers is there, startup finance is there, securitization is there. And I think these are the major chapters which are hardcore theory oriented chapter. Am I right? So friends, these particular chapters I have already recorded. I have already created a course which you can revise in a very short span of 8 to 9 hours. My today's agenda is not to cover this again. What I will instead do is at the in the between the classes, once let me start off with my class. In between, maybe around 10:30 or something like that, I will give you the coupon code so that you can purchase these classes for 0 rupees. Maybe you'll have to pay some transaction fee of 5 rupees or 7 rupees. That would be mainly the transaction fee that is coming in. Apart from that, nothing will come in. So you get all these lectures along with that. My main agenda to cover today's session would be on these three major chapters, which has got a lot of theory, and of late they are asking theory related questions in the examination. The first one is derivatives, second one is portfolio management, and the third one is security valuation. Okay, everybody clear with this part now? Yes. So friends, in these three chapters, derivatives, portfolio and security valuation, in order to cover the theory, I had made a WhatsApp group. I believe you're all a part of the WhatsApp group. If you are not, please join the WhatsApp group, because that is where I'm putting all the important classes for May 2025. Today we are having a theory marathon. Next week we are going to have case study digest. The week after that we'll have RTP, MTP. So like that, every week we are going to do one long session where we'll be covering a lot of things. So I just request you to stay active in that group and don't mute that group. I won't be putting any unnecessary message. Max to max you'll be getting maybe one message a day or maybe two messages a day. Nothing more than that. So just that, keep that group active so that you are aware of the free lectures that I'm going to take for the upcoming May 2026 examination. Is everybody clear? Now, in order to teach these chapters, I will be using a technique, and this technique is called as paraphrasing technique. This is a very powerful technique, friends. Okay, so what happens as a part of this technique is that by using less words, you learn more. And if you use this properly, let me give you one assurance. One day before the exam, you can revise the entire AFM theory in only 1 hour. Friends, this is one advantage what many others will not be having, but you alone will be having this kind of an advantage. So what happens is when others are spending 3 hours, 4 hours doing theory, you can do that in 1 hour of time. You save the extra 3 hours which can be used for studying more and more and more problems. Am I right? So my objective here is to teach you this technique and teach you the class in such a way that once you complete my class tomorrow, by investing hardly 30 minutes, you can revise these 3 chapters, that is derivative, portfolio management, and what is the other one I told you? Security valuation. So friends, I hope all of you are clear with the technique that we are going to start use for this particular theory marathon. Keeping this, shall I begin with today's session now? Perfect, friends. Let us start off first. Let us first start off with the first session on derivatives. This chapter has some beautiful load of theory. So to teach this theory, first what I will do is I will open the paraphrase that has been created. What exactly is a paraphrase? Okay, a paraphrase is basically short words. Now if you look over here, for example, meaning, you can only see 3 or 4 headings over here. By looking at this 3 or 4 headings, I will be able to complete or explain to you the entire meaning of this thing. So basically these are keywords, less words but keywords. Using these keywords, you will be able to learn the entire AFM theory. Are you all clear with this part? I'll just open it once again. I want to open it with Microsoft Edge. I'm more comfortable in Microsoft Edge. Right. So friends, let us start with the first part, derivatives. So friends, in problem classes, you would have learned, in my class also you would have learned that there are mainly 3 types of derivatives. What are the 3 types of derivatives? Everyone tell me. First one, what you have over here is a forward contract. And yes, friends, I'll be sharing with you these handwritten notes also. So when I'm taking this class, along with me, keep on scribbling. But I won't be giving you so much time because we want to cover the entire theory also, right? So you keep on scribbling along with me. At the end of the class, this entire theory PDF will be shared with all of you. Everyone clear? So once that is done, it becomes very easy for you. You just have to study this theory and you can go for the examination. But give your study material one reading, because what I'm teaching you is the logic or the way to remember it. But one time only when you read the textbook, you'll get the full-fledged clarity about what is about to happen. Everybody clear with this part now? So now friends, tell me, what are the 3 types of derivatives that you have learned? First one is a forward contract. Second one is futures. Third one is mainly options, and then I believe that you would have learned about swaps. In all these cases, the value is derived from the underlying asset. So now let us say, if I'm talking about Reliance Future, what is the underlying asset for Reliance Future, friends? It is the Reliance stock. That is going to be the underlying asset. Everybody clear? So one very, very important factor that you would have already learned in your problem driven classes is that a value of a derivative is something that is derived from the value of its underlying asset. Everybody clear with this part now? In between, whenever I ask you, you're clear, just type a Y in the chat box. Y enter, Y enter. Why I'm asking you that is because that will help you all to stay focused with whatever I'm doing. And one more request, friends, maybe for the recorded students, I'm not sure if my live students can do that. I need your help for timestamps. So whenever you're watching the class, please put your timestamps over there so that, later on when the future students are referring, they can easily go through it and, they can study along with that. Okay. Please do this one help for me. I'll be very, very grateful to all of you, friends. And yes, as I always request, please like this video and subscribe to my channel so that you get many more things. Apart from the live classes, you also have a free Forex revision. Every Forex concept explained with a small MCQ questions in 5 minutes. So by investing that 5 minutes, you can learn 111 concepts of Forex. That is also there in the YouTube channel. So please subscribe to my channel and yes, like this video also. So friends, what is the first one? Like it only if you genuinely like it, okay? So now let's start with derivatives, friends. So inside derivatives, you are having 4 parts. What are the 4 parts that you're having over here? Forward, Future, options, and what is the last one? Swap. In each of these cases, the value is derived from the value of its underlying asset. Everybody clear with this one part now? Okay. So here, when you look at the meaning, what is the first word that you see in the meaning? Underlying asset. That's what I told you just now. The value is arrived from the value of its underlying asset. What is the second point that I have told over here? 10% change in the spot will result in 10% change in the derivative. Yes or no? If the Reliance spot goes up by 10%, by default, what will happen to the Reliance future? Reliance future will also go up by how much percentage, friends? It will also go up by 10%. Everybody clear? Third, and a very, very important feature of a derivative is that only the gain or loss is going to be real. So what happens now, for example, if you're talking about options. So in case of options, let us say my S1, E1. I'm talking about buying a call option. So S1 is going to be 120, E1 is going to be 100. What does that mean? That you have a right to buy at 100. Outside market, you can buy for 120. So what action will you take over here? You will exercise. In that case, what will be a GP, friends? It will be 20. Friends, this 20 is the only money along with premium which is paid in the option market. So even though we technically say that I will buy at 100, sell it at 120, etc., in reality, they work on net settlement basis because only your gain or loss is going to be real. Rest, everything is going to be what, friends? Rest, everything is going to be imaginary. So everyone tell me, friends, what are the highlights of a derivative transaction? Point number one, the price of the derivative is derived from the price of the underlying asset. Rule number two, for every 10% change in the spot market, future will also change by 10%, option valuation will also change by 10%, even your forward will change by 10%. Everybody clear? Last one, in derivative, you don't have a full-fledged settlement policy. You only have a net settlement and only the gain or loss is real. Rest, everything is imaginary. Is everybody clear with this part now? If you are clear, type a yes or Y in the chat box, friends. Fantastic. So I believe you are clear with the first basics part. What is the meaning of the word derivative? Now let us go to the second part. What is the purpose of having a derivative? So friends, purpose changes from people to people. So when I talk about purpose, okay, the same derivative. Now let us say inside derivative we are talking about futures. Why would a company, any company, why would it go for futures? It will go for futures only for the purpose of hedging. Friends, the entire forex chapter, what we learn is this particular thing. They have a receivable. So for the receivable, they will do a hedging. How will they do hedging? They can do it using home currency invoicing. They can do it using forward contract. They can do it using futures contract, etc., etc. Everybody clear with this part now? Fine. When you talk about other investors other than company, these people normally do it for speculation. Now tell me, friends, what is the meaning of the word speculation? Many people are entering the stock market only to make profit or loss. They will buy Reliance future, sell Reliance future. What is the objective of buying and selling Reliance future? So that they make any profit or they make a kind of a losses over there. So now once again tell me, friends, company. Why does a company enter into a derivative? For the purpose of hedging. Why does an investor enter for hedging for derivative? For the purpose of speculation. The third category that comes over here is called as institutional investors. So for example, for institutional investors is whom? Mutual funds. For mutual fund, it is nothing but is it at a asset allocation. So mutual fund has 1000 crore rupees. They are putting 700 crore in stock, 100 crore in gold, 50 crore they will put in futures or something like that, because there they will be getting a higher return compared to whatever returns they were getting in the other places. Everybody clear with this part now? Yes. And the last one is dealers or brokers. Friends, give me an example of a broker. Have you heard of Zerodha? Zerodha is a broker. Why does Zerodha trade in futures? Their objective of trading is charging commission. So friends, these are the four purposes for futures or any derivative. Company uses a derivative for hedging, investor uses derivative for speculation, mutual fund uses derivative for asset allocation, and broker uses derivatives for commission. Can you quickly scribble it down? And please let me know, are you clear so far? Can I go to the next part now? All right, friends. Now I'll go to the next part. So we have spoken about what is the meaning of derivative. We have also spoken about what are different types of examples of derivatives. We have also learnt about the purpose of derivative. Can I go to the next part now, friends? Fantastic. So after you are done writing or learning till here, next comes a forward contract. This I am not explaining much over here because it is already explained in my classes. A forward contract is a contract that is entered today to be executed on a future date. Everyone repeat once again. What is a forward contract? A forward contract is a contract entered today to be executed on a future date. Okay. Then next is future contract. This also we have learned in my classes. So what have we learned in futures contract? Everyone tell me. A future contract is also a contract entered today that is executed on a future date. Now tell me, friends, I'll give you 10 seconds time over here. Put a chat in the chat box and tell me what is the difference between a forward and a future? What is the difference between a forward and a future? Come on. I'll give you 10 seconds time. You can think and put it in the chat box. In the meanwhile, I will open the study material here. Friends, study material has been updated for May 26. Okay, so we are right now doing the updated study material for May 26 exam. Tell me, friends, what is the difference between a forward and a future? Fantastic, Anand. Margin. Margin is one of the very, very valid points, in case of futures. So futures are having margin. Forward does not have margin. Anand, second point is also very, very good. In case of futures, we deal in number of contracts or we deal in contract size. Fantastic. Fantastic. Okay. Next one. Mary's Paul, you have told futures are traded through organized exchange. Fantastic, Mary's. Yes, you trade only in NSE, BSE or similar places. You don't just deal just like that. Future exchange is traded. Fantastic, Aditya. What you said is also absolutely correct. So friends, here, these are all the meanings of future contract. But in page number 9.5, they have given a table. That is why I didn't want to copy down the whole table. So I'm just showing it over here. Whatever you have told are the points over here. Point number 1, trading. Forward are traded on a personal basis. Anybody can enter into a forward contract. The moment you fill the examination form telling that you're going to write the exam in May 2026, that is a forward contract. But futures are traded only in a competitive arena. Okay. Agduman, you have a doubt? Please ask me your doubt. Size of the contract. In case of forward contract, it is all customized. But in case of future, it is standardized size. Like for example, one Reliance future will have 500 shares minimum. Everybody clear with this part? Third one, organized exchanges. Again, futures are traded in NSE, BSE, you already told. Forwards are traded in over the counter market. Anybody can enter into a forward market. Everybody clear? Next one is what? Settlement. So in forward, the settlement happened between the mutual agreement. Future, it happens on maturity. Okay. And it is done through exchanges clearing house. You cannot do it directly. Delivery date, forward you can decide. Future, you are having different delivery dates. Normally it is 3 months. So if you are in March, you will have a delivery date for 26th March. You will have a date for 26th May and 26th June. That is how normally futures work. Transaction cost is based on mutually agreed. In case of future, it is a brokerage fee. Mark to market. In future, you have to do marking to market, but in forward, you cannot do marking to market. These are the 7 points. Then margin. I think somebody already told about margins. Not required in forward, required in future. Last one, credit risk. Where do you think you have a higher credit risk? In case of forward or in case of futures? You have a higher credit risk in forward because tomorrow anybody can run away. After filling the examination form, you can just escape. But in case of futures, it is not like that. In case of futures, you have to deliver. That is why you have initial margin, maintenance margin, mark to market margin, which we have already taught you. So friends, take a 1 minute cool off time. Read through this. If you have any doubts, you can ask me. Agduman, what was a doubt that you had? Please let me know. So this one table you have to try recalling from your mind, after which you have to just go through this table once. All right. Yes. Are you all clear so far? Can I go to the next part? So what and all did we learn so far? We learned the meaning of derivative. So what is the meaning of derivative? The value derives from the underlying asset. 10% change in the spot will result in 10% change in the derivative. Only gain or loss is real. Companies use it for hedging. Investors use it for speculation or hedging. Okay. Institution might discuss about arbitrage. Dealers will talk about dealers commission. Everybody clear with this part? Agduman, I may sound stupid by asking this question. I had this in my mind for very long. Cap markets are controlled by giants. हम जैसे बच्चों को क्यों टॉर्चर करा जाता है? Agduman, you can be working in one of these giants. Why don't you go and work in one of these giants? If you work with them, you will be playing with the market. Then, bacche like you will not get tortured. Bacche like you will make money. Friends, as a chartered accountant, if you enter into stock trading, like, joining companies like Goldman Sachs or joining a mutual fund as a fund manager, your salaries are paid in crores. Average salary of a fund manager who's managing one of the top class funds, their average salary is 2.5 to 3 crores. You don't get that as a auditor in any other place. Okay, so yes. All right, Agduman, I hope I have clarified your doubt now. Yes, we'll go to the next part now. Yes, next one. So friends, I think we learned about forward contract. We also learned about futures contract. Now we go to the next heading called as basis. Everyone write down the next heading, basis. The formula for basis is spot minus futures. So let us say a stock is having a spot price of 100 rupees. Tell me friends, how do you find out the future price? F0 is found out using the formula S0 into e raised to RT. Do you remember this? So let us assume using this formula, you're getting the future point as 120. So in this case, what is the basis that you get over here? Do you get the answer as 20 basis points? Or the logic is that the future rate is 20 rupees more than the forward rate. Sorry, not the forward rate, more than the spot rate. So the higher the basis, that means higher is the expectation. Only when your E raised to RT goes up, your future rates will become more. Everybody clear with this part now? Yes. So what is the formula for basis? Everyone tell me. It is spot minus futures. Is everybody clear so far? Type a yes in the chat box if you are clear. Fantastic. So I believe all of you are clear with the meaning of the word basis. Okay. Now, theoretical future price. This is something what we have already learned. What is the formula for theoretical future price, friends? The formula is S0 into e raised to RT. Friends, whatever we have learned in our problem driven area, I will not be covering that as a theory part. Okay. Only the new part which is not covered as a part of the problem driven area will be covered in the theory part. Everybody clear with this part? Now, spot, forward, future. Now, there are two markets. What are the two markets? The first market is called as the spot market and the second market is a derivative market. Correct? So let us say the spot price is turning out to be 100 rupees. Inside derivative, you can have a forward contract or you can have a futures contract. Now everyone interact and everyone tell me, what is the definition of a forward contract, friends? A forward contract is a contract entered today to be executed on a future date. Now tell me, what is the formula for, what is the definition of a future contract, friends? The definition of a future contract is also a contract entered today to be executed on a future date. Only difference is that forward is non-standardized and future is standardized. In that case, if your forward price is 120 rupees, ideally your future should also be around 120 rupees only. So can I say theoretically the forward and future price of a security shall be the same? Is everybody clear with this part? Please type a yes in the chat box. After every concept, I'll give you a 5 to 10 minutes cool off time so that your brain can absorb this and then we go to the next part. Otherwise, it will be just me covering the entire thing and you will not get benefits of that. I hope you are comfortable with this one particular pattern in which I'm taking the class, friends. If you want any change, just let me know and please write this down. Like this, slow and steady will complete everything. Okay. All right, friends. Are you all done with this part? Can I go to the next one now? So what did we learn over here? We learned a few things. We learned the basis points is nothing but it is spot minus futures. We learned that theoretical future price is nothing but S0 into e raised to RT. And then we learned that for spot market, from that you derive future, you derive forward also. Same value for same maturity. So for a 3-month forward and a 3-month future will ideally have a same value. Okay. So I think we are clear with this part also. Now they're asking types of future contract. So what is the next heading? Types of future contract. So friends, here they have taught you two things. One is what they call it as single stock futures. And the second point that you learn over here is called as index futures. All right. Now, single stock futures, the example is Reliance futures, Zomato futures, Tata futures, etc. These are all single stock futures. What about index futures? Nifty future. Are you understanding my point? So Nifty future is an example of what it is, an index. Index means what? Market. Similarly, you will have a BSE future. What is the BSE future? Bombay Stock Exchange future. Okay. So let me ask you one question, friends. I'll wait, since in YouTube you normally have a 10 seconds lag. I will wait. You tell me where is it better to invest? Is it better to invest in single stock futures or is it better to invest in index futures? Come on, tell me. Hello? Yes. Tell me, friends. which is better? Single stock futures is better or index future is better? Sengamalavalli says index. Everyone says index. Fantastic. Why do you say index? Friends, index is the entire market. So when you talk about the entire market, have you not learned that diversification reduces your risk? Yes or no? Diversification reduces your risk. So that is something which is very, very important. So ideally, what is better for all of you friends? It is the index future which is better for all of you. Everyone clear with this part now? Please type a yes in the chat box. So we learn the theory. So merits of index futures are, point number one, they are flexible. Yes, index futures are having so many stocks, it is much more flexible compared to a normal stock. Yes or no? Diversified. Diversification reduces your risk. It is cheaper than single stock because one stock you buy, you have to pay a commission. When you buy in bulk, the commission also gets diluted. Okay? Cannot be manipulated. Friends, now suppose I am Ambani. I can do some things or put in some fake news using which Reliance future price can go up. Yes or no? But if I am an index is the average of 50 securities. There is no way I can manipulate that. Last point is what? Less volatile. That is because diversification reduces your risk. So automatically what will happen? Your standard deviation will also come down. Everybody clear with this part now? Please quickly type a yes in the chat box. These are the merits of index future. Flexible, diversified, cheaper, cannot be manipulated, and less volatile. Fantastic, friends. Everybody clear with this part now? Can I go to the next one? Next one is options. So, friends, we have already learnt about options. There are ideally two types of options. Everyone tell me what are the two types of options that we have learnt over here. One is called as a call option and the other one is called as the put option. What do you mean by a call option? A call option is a right to buy. And what is a put option? It is a right to sell. I believe we have learned this already in our class. So here they are saying, just like in case of futures, we can also have stock options. We can also have index options. Now, once again, tell me friends, which one will be better? Stock options are better or index options are better? The answer will be the same that we learned earlier. So tell me what was the answer that we learned earlier? Index options is better. Why? Same reason. It is flexible, it is more diversified, it is cheaper, cannot be manipulated, and it is less volatile. Everybody clear with this part? Yes. So stock options, index options. Everybody clear with this part now? Fantastic. Great job, Marys. Great job, Rasika. Keep on chatting. That way I can be very clear that you're understanding everything. Now we come to the tricky part. So far, we were learning theory that was very common. Now we are going to learn about certain things that we have not learned earlier. First name that you need to learn is called as Greeks. Now, you all would have heard that Greek is a language. Here, we are talking about Greeks. Greeks are statistical values which inform the investor how the stock is performing. So, basically, what is the question we are trying to answer over here? How the stock is performing. Everybody clear with this part? How the stock is performing. So to find out this, there are multiple things that we'll have to learn. We will have to learn about delta. We will have to learn about RHO. We will have to learn about theta. We will have to learn about, I think, Vega, etc., etc. All right. So in the first one that comes in front of you is what you call it as delta. So write down the next heading in your books. Delta. Everybody clear with this part? Friends, delta, the concept is very simple. what is the change in the option value for every 1% change in the price. So what is the change in option value for every change in the spot price? So I can indirectly say the formula is C1 minus C2 divided by S1 minus S2. So here C1 minus C2 will be the change in the option value. So let us say the spot price is turning out to be 120 rupees minus, let us say it is falling down to 100 rupees, for example. Okay. Now, what is the change in the spot price? You have a change of 20. Now, you have a right to buy at, let us say, 90. So now what happens is, when the price goes up to 120, you get 30. When the price goes up to 100, you get 10. Or maybe let us assume that the exercise price is 110. Now, you have a right to buy at 110. Outside market, you can buy for 120. Will you exercise or will you lapse? You will exercise. How much will you get? 10. Minus. You have a right to buy at 110. Outside market, you can buy for 100. Now, what will you do, friends? Will you exercise or will you lapse? In this case, you will lapse. Am I right? So, now tell me what is 10 minus 0. Do you get the answer as 10 over here? Correct. So, do I get the answer as 0.5? Or what is the logic of this 0.5? For every 1 rupee change in the spot price, option value will change by 0.5. And friends, this 0.5 what you get is also called as hedge ratio. There is one useless question in your books which is based on hedge ratio. I will show you that question now. First, take a 1 minute school of time. Write down this. I think we are getting into a little heavy topic, so I want to slow down a little bit. Are you all clear with this part? If yes, please type a yes in the chat box. I just want to check one small thing, friends. Yes, please write down this in your books. All right, friends. Are you all clear with the concept of delta? I think you're still writing, Rasika. Yes, please write down. I'll give you a minute's time. Write it down. I don't want to rush here. Now we are getting into heavier topics. We will go a little bit slow over here. Okay, please write it down. Fantastic. So are you all clear with the concept of delta? So we have learned two words over here. First, we learned a word called as Greeks. What do you mean by the word Greeks, friends? Greeks is statistical values, which will tell you whether the company is performing well or no. Everyone clear? Next thing that we learned about was delta. So what do you mean by delta? For every 1% change in the value, what is going to be the change in the price? Now, there can be two types of things. One can be in the money or it can be out of the money. Let us analyze that. Tell me, friends, what do you mean by the word in the money? Okay, I'll give you scenario 1, 2, S1, E1, 120, 100. Let us say your exercise price is 100 and 100. Okay, now tell me what will be the action that you will take in the first case. In the first case, you have a right to buy. I'm talking about buying a call option. So what do you mean by buying a call option? A person has a right to buy at 80. Outside market, he can buy for 120. So will he exercise or will he lapse? He will exercise. So his GP will be how much, friends? It will be 40. Or this GP is what we call it as value of the option. Now tell me what will be the status in this case. In case the status will be in the money. Yes or no? Now what about the second one? I have a right to buy at 80. Outside market I can buy for 100. So what will I do again in this case? I will exercise. So if I exercise, I will get a GP of how much over here now, friends? I will get a GP of 20. Everyone clear? Again, can I say it is in the money? Now tell me, my dear friends, what is the formula for delta? Delta is found out using the formula change in the option price divided by change in the spot price. So 20 by 20, do I get the answer as 1 over here? So can I say if the option is in the money, my delta value shall be how much, friends? My delta value shall be 1. Take 1 minute time, scribble down. This is a little tricky. I am slowing down a little bit. Yes, friends. Did you understand this part now? Can I go to the next one? Same way, now let us do an example for out of the money. What do you mean by the word out of the money, friends? Out of the money means you are always going to lapse it. Am I right? So let me just go and put out of the money now. So for example, S1, E1. Now let us say the S1 is the same 120 and 100, but your E1 is going to be 150 and 150. All right. Now tell me in this case, what will be the action that you will take over here? Lapse, lapse. So what will happen to your GP? Your GP will become 0 and 0. Am I right? So in that case, what is going to be the status that you get over here? The status will be out of the money, out of the money. Yes or no? So when it is going to be out of the money, the GP is going to be 0. Now the formula for delta is going to be what? 0 minus 0 divided by 120 minus 100, or 0 divided by 20. Will I get the answer as 0? Or can I say if an option is out of the money, your delta value will be equal to 0. Now tell me, friends, if the all the options are in the money, delta value will be 1. All the options are out of the money, your delta value will be 0. Is everybody clear with this part? Type a yes in the chat box. Then I will go to the next one. Fantastic, friends. Can I go to the next part now? So I think we are clear with the concept of delta. Change in the option value for 1% change in the price. All right. So I think we are clear with this part now. So next thing they're asking is call deltas are always positive, put deltas are always negative. Shall we check that part also? Okay. We did call delta so far. We got the answer as +1 over here. Now let us do a put delta. Okay. Ready? So I will take a put option. S1 E1. Okay. Let us say this is turning out to be 120 and 140. Your E1 is turning out to be 200, 200. All right. So now you have a right to sell at what price, friends? You have a right to sell at 200. Outside market, you can sell for 80. So what will you do? You will exercise. What will be your GP now? It will be 80. Now, if the price is going up to 140, you will exercise, but your GP will now be 60. So now what will happen is, what is the formula for delta? Change in option value. So the change in option value over here is going to be 60 minus 80 divided by 140 minus 120. Yes or no? So the answer would be minus 20 divided by plus 20. Or do you get the answer as -1 over here now? Everybody clear? So if the option is in the money, friends, I'm giving the whole logic. It is not given in your textbook. I'm giving the whole logic because once you get the whole logic, later on when you studied, you don't have to by heart this. You can derive it from your mind. Okay. If the option is in the money, put delta will be what, friends? Put delta will be -1. Everybody clear with this part now? Same way, if it is out of the money, you will get the value as how much? You will get the value as 0. So from this, can we derive one thing, that whatever is your call delta, this is going to be positive, and your put delta is going to be negative. Everybody clear with this part? Then what they are telling over here is that put delta is actually nothing but it is your call delta -1. Let me explain this to you now. Are you ready, friends? I'll take the same example which I took over here. S1 120 140. 120, 140. E1 is how much? 200, 200. Now suppose this was a call option. We did the same data using put option earlier, right? If it was call option, you have a right to buy at 200. Outside market, the price is turning out to be 120. Am I right? What will you do? Will you exercise or will you lapse? You will lapse. So the value will become 0. Here also 0. So when I work out call delta, what will be the formula for call delta? 0 minus 0 divided by 140 minus 120. Or do I get the answer as 0 over here, friends? Now we'll put the formula. Put delta is equal to call delta. How much is call delta over here? 0 minus 1. What is 0 minus 1, my dear friends? Do you get the answer as -1? Is this exactly the same -1 that you got over here? Hence proven that your put delta is nothing but it is going to be call delta -1. Take a minute's time. You can scribble down this data in your books. Thank you so much, Jagan. My only request to all of you is that I have taken a lot of efforts to make this theory marathon. Same way, I'll be taking much more efforts for case study digest, RTP revision, and many more that are coming up. Just share and pass on this information with your friends also so that maximum students can benefit from this. Okay? And yes, like the video, subscribe to the channel. My social media team has told me that I should expressly keep on telling this to the students. Otherwise, students will forget. Hope that's okay with all of you. Are you all done writing till here in your books, friends? Are you clear so far? Yes. Okay. So I think we are clear with what is a put delta and we are also clear with what is the call delta right now. Okay, so we learned about delta. Once again, let us revise. What do you mean by the word delta, friends? Change in the option value for 1% change in the price. Okay, if it is in the money, you get the value as 1. Out of the money, you get the value as 0. And then we learned that all the call deltas are positive, all the put deltas are negative. Put delta is nothing but call delta minus 1, hence they are inversely related. One increases, other one decreases. And delta is also called as what? It is called as hedge ratio. Friends, you have a question in your books. Dayal, do you remember that question? That question is based on delta. Many of you wouldn't have understood at that point. You would have done it just like a question. Dayal, this question, friends, mark it if you want. This question is, they have given, see, 780, 480. They have also given the option price. So from this, what combination of share should Mr. Dayal select if he wants a perfect hedging? Here they have used the hedge ratio, C1 minus C2 divided by S1 minus S2. I hope you are able to connect this question now with that. I have done this question in YouTube also, friends. You can go through this. It's a very, very good question. Okay. So yes, so we are done with delta. Now let us learn about gamma. Write down the next heading in your books, gamma. So friends, when you talk about gamma, what they are trying to tell is, what is the change in delta for every 1% change in the spot price. So friends, now the formula will be D1 minus D2 divided by S1 minus S2. So delta 1 minus delta 2 divided by what is the change in the spot price. Everybody clear with this part? So this is only a pure theory part. You just have to learn this. They are not giving you practical application, but I'll show you one practical case study using Black-Scholes model very, very soon. So that is the meaning of the word gamma. So friends, we learnt about delta, then we learnt about gamma. What is gamma? For 1% change in the stock price, what is the change in the delta? Next one is theta. Theta is a measure of time decay. So we'll write down the next heading, theta. This is a measure of time decay. So basically, for example, I'll give you an example. S0 is, let us say, 120. Your exercise price is, let us say, 100. I'm giving some random numbers. And let us say the duration, RF is turning out to be 10%. Let us say the duration is 3 months. Okay. So these are the details given. Now what happens is, this will have a value of a call option. So let us say the value of the call option is turning out to be 18.1. This is actually based on an actual question in your textbook, which we'll discuss later. Now, if the duration is 3 months, we get a value of call option as 18.1. Suppose tomorrow the duration falls down to 2 months. Now, will the call option value remain the same? The option value will not remain the same because maturity has come down. So the probability of the risk has also come down. So ideally, there will be a change in the call option. So for every 1 day change in the duration, what is the change in the price is what they call it as theta. Everybody clear with this part? So let me summarize. We have learned about, first we learned about delta. What do you mean by delta? For every 1% change in the price, what is the change in the options? That is called as delta. Then we learned about gamma. 1% change in the price, what is the change in the delta? Now we learned about theta. For every 1 day decrease in duration, what is the change in the option value? Is everybody clear so far? Please type a yes in the chat box. Yes, friends. Are you all clear? Next one is called as RHO. Next one is called as RHO. This says what is the change in the option for every 1% change in RF? So friends, now tell me, if your RF risk free is right now 6%, tomorrow if your RF increases to 7%, by default the investor expectation will also go up. If investor expectation goes up, normally the price will fall down. If the price falls down, your option value will also fall down. Yes or no? So that change, what comes in the change in the option value, is what you find out using RHO. Is everyone clear with this part now? So we learned about multiple things. Come on now, even though I cannot see you, you have to recall with me. First we learned about delta. What do you mean by delta? Orally tell it without looking at the book. Yes, 1% change in the price. What is the change in the option? Next question, gamma. What does it mean? Yes, 1% change in the price. What is the change in the delta? Okay. Then what is the next thing that we learned over there? We learned about theta. What do you mean by theta? Change in the option price for every 1 day reduction in the duration. What did we learn next? RHO. What do you mean by RHO? For 1% change in RF, what is the change in the option value? Friends, I am also getting confused. I hope you are not confused now. Last one, Vega. Change in the option for change in volatility. Volatility is nothing but standard deviation. So Vega says change in the option for change in the standard deviation. Everybody clear? So let me make a summary so that everything can be very, very clear for all of you. In the summary, first we learnt about delta. Okay, so here it is. Change in options value for every 1% change in what? In the spot price. Yes or no? Then we learnt about gamma. That is change in what now? What is gamma? Gamma is change in delta for 1% change in the spot price. Then we learnt about theta. Here it is the change in the option value for the percentage change in the time duration. Yes or no? After that we learnt about RHO. Change in the option value for change in RF. Then I think we learnt about Vega, if I am not wrong, correct? Yes, Vega. Change in the option value for change in the standard deviation. Can you scribble down these numbers in your books, friends? And if you're clear with this plot, please type a Y or yes in the chat box. All right, friends. Are you all clear with this part now? Can I go to the next one? Ready? Okay. So I think we are done with delta, gamma, theta, RHO, Vega. Now comes an even more interesting topic which is called as exotic options. Write down the next heading in your books. Exotic options. Friends, we have learnt about only vanilla options in my class. So when I say vanilla options, either a call option or a put option is a vanilla option. Everybody clear with this part? Okay. Now, exotic options are crazy options, or what I can say is that they are custom made. Or in simple terms, I'll give you examples of exotic very soon. I would say these are standardized. But friends, exotic options are not standardized. This is something what you can decide from a person to person basis. Okay, I hope everybody is clear so far. So we are learning two types of options over here, friends. What is the first one? First one is called as an exotic option, and the second one is what we call it as a vanilla options. So let us do some examples of exotic options. So when you do that, you will understand it better. Exotic options are traded in OTC. What do you mean by OTC? Over the counter. So that is OTC means anyone can trade with anyone. It is more complex than vanilla. I think when I give you one example, you will understand. For example, chooser options. This is a beautiful option, friends. Now let us say, I'll give you an example. Let us say today is January 1st. Okay. What is today's date? January 1st. For a duration of 3 months. So what will be the maturity date? Everyone tell me. Maturity date will be March 31st. Everyone clear? Okay. Now on this date, S1 I don't know. E1 is, let us say, 100 rupees, or I have a either right to buy or right to sell at 100 rupees. Alright. This data is available. Today the spot price is also turning out to be 100 rupees. Now, normal cases, today only we buy a call option or today only we buy a put option. But in chooser option, we can choose on March 31st whether I need a call option or a put option. Beautiful option, friends. Did you understand what I'm trying to tell you over here? So what is going to happen in this case is, see, suppose the S1 on the last date becomes 150 rupees. In that case, will you take this option as a call or a put option? You will change it as a call option. By doing so, you will get a GP of how much over here, friends? 50 rupees. Now, suppose S1 turns out to be 60 rupees. What will you do it? You will choose that this option is going to be a put option. Even then you will exercise and your GP will become how much? 40 rupees. Beautiful option, friends. This is what you call it as chooser options. I can choose on 31st March whether I need a call option or whether I need a put option. Everybody clear? Now you'll be thinking, which crazy fellow will enter into this? Friends, for these kind of exotic options, it is non-standardized. You cannot do it in the stock market. So premium will be very, very high. This fellow will take a minimum premium of 50 rupees. Highly risky, right? Because now if the price goes up also, you make a loss. Price falls also, you make a loss. Correct? So in these cases, they charge a higher premium. Very, very high premium. Are you clear now, friends? Perfect. So I think we are clear with chooser options now, correct? Next one. Like chooser option, the next option that you have to learn is called as the compound option. This is right to buy another option at the end of the first option. So next one is called as what? Compound options. So now, today, what is today's date? Everyone tell me. Today is January 1st. So the maturity is going to happen on what date? Maturity is going to happen on December 31st. Everybody clear with this part? Okay. So today is January 1st. Maturity date is what? December 31st is maturity date. Today the S0 is 100. E1 for 3 months is 100. S1 we don't know. Let us say I entered into buying a call option. Okay. Now S1 turns out to be 130 rupees. So tell me, friends, if S1 turns out to be 130 rupees, your E1 is turning out to be 100 rupees, your GP will be how much? 30 rupees. Now on March 31st, I feel the prices will go up further. So in compound option, I will buy I have a right to buy another call option. Okay, again at what price? 100 rupees for further 3 months. So by doing so, I can double my profit over here. This is the meaning of compound options. Are you clear with this part, friends? Please type a yes in the chat box. Can I go to the next part now? So we are done with compound options also. First we learned about what? Chooser options. Next, what did we learn about? We learned about compound options. Now we learn about the next one, which is called as barrier options. Beautiful, another option, friends. I will again give you an example of barrier options. Okay? Yes. Suppose today is what date, friends? January 1st. Today the spot rate or S0 is turning out to be 100. You have an exercise price also of 100. Okay. I want to buy a call option. Okay. But ideally, friends, when will the call option help me? Only if the price is going to go up. Am I right? So here I will tell that if, let's say, duration is 3 months. This is January 1st to 31st March. So here you will put a condition that if on January 31st, if the price is greater than 110 rupees, then alone execute a call option, or else drop it. Did you understand what just happened over here? So on January 31st, if the price is going above 110, only in that case you are going to execute the option. If the price is 105 or 106, you don't enter into a call option at all. Barrier options. Only once a barrier is crossed, you will end up getting that benefit over here. Is everybody clear with this part? Type a yes in the chat box. All right. Can I go to the next one now? Okay. So we learned about chooser options. You can choose whether it's a put option or a call option. Then you learned about compound options. That is nothing but split fee option. You have a right to buy another option at the expiry of the first option. Then we learned about barrier options after you reach a barrier part. Then you have binary options. Now tell me, friends, what is the meaning of the word binary? Binary means two numbers. What are the two numbers? 1 and 0. Or 1 means yes, 0 for example means no. So same way, binary option depends upon an event. For example, will US bomb Iran? There can be two answers. What are the two answers? Yes, or it can be no. If US bombs Iran, maybe the US stock market prices might go up, thinking that US has won the market. Okay, so you feel the prices will go up. So what you'll do, if it is yes, you will buy a call option. If it is no, drop the plan. These kind of options is what you call it as binary option. It depends on a particular event. If the event happens, buy a call option. If the event does not happen, drop the plan altogether. Can you scribble down this, friends, and give me 1 minute time? I'll fill some water and I will come back. I hope the audio, video, everything is absolutely clear and you're understanding everything thoroughly. Please write it down. I'll come back in 1 minute. Yes, friends. I'm back now. Shall we continue? So, what are the options we learned? Chooser option done, compound option done, barrier options also done, binary option also done. Next one is called as Asian options. What they do in Asian options is, for example, January 1 to March 31st. This is going to be the duration. Everybody clear with this part? Okay. So the duration is going to be January 1 to March 31st. S0 is 100. E1 is also 100 rupees. Alright. Now let us assume the S1 turns out to be 150 rupees. So they don't normally, how do we do it normally? So I'll give a heading called as normal. In normal, what do? We take the S1 as 150, E1 as 100, then we take the action called as exercise. Your GP will be 50. Am I right? That is normal. But here they don't do it like this. What they will do in Asian options is that they will take the average as the S1. So here the average will be 125. How did I get this 125, friends? 125 will be this 150 minus 100 divided by 2. So I think you will get the answer as how much over here? 125. Everybody clear with this part? Okay. So, and then you take the E1 as 100, exercise, your GP will be 25. So in Asian options, average of the spot price is considered. Everybody clear with this part now? Average of the spot price is considered. Everybody clear with the concept of Asian options, friends? Yes? Can I go to the next part now? Okay. So I think once you are done with this, I think we have learnt about Asian options also. All right. Average price of the underlying asset is considered. Okay. Then the payoff is decided. Next option is called as Bermuda options. Friends, how does a Bermuda look? Wait, I'm just doing some basic drawing. Don't judge me with this drawing. Suppose this fellow is wearing pants. This is this fellow's legs. Assume if he wears, this is a full pant. Yes or no? This is called as a pant. Friends, my drawing skills are pathetic. So please pardon me. Okay. So again, this is his leg. No idea what I'm drawing right now. If he is wearing something, let us say till here, I will call it as a knicker or trousers. Yes or no? Now I'll draw the third one. Friends, my objective is to explain the concept to you. Please don't judge my drawing skills. Oh my god. This one is absolutely pathetic. That's okay. This fellow is not wearing a pant, he is wearing a Bermuda. So now tell me, friends, what is the meaning of the word Bermuda? Or forget the meaning of the word. What exactly is Bermuda, friends? Bermuda is a midpoint. This is a midpoint between pants and trousers. Do you agree with me? Bermuda is a midpoint between pants and trousers. Exactly like that. Bermuda options is nothing but it is a midpoint between American option and European option. Tell me, friends, what is the meaning of American options? I will give you that below. American options can be exercised anytime, whereas European options can be exercised only on expiry. Anytime, only on expiry. Now we are learning a third type of option. What is the third type of option? It is a Bermuda options. So Bermuda is coming in between American and European. So what will actually happen in a Bermuda option is that you can exercise only on certain dates. American you can do anytime. European only on 31st March. Example, I can do it on January 31st, February 28th, and March 31st. Did you understand that point? That is the meaning of Bermuda options. I hope, friends, this diagram has helped you to understand what is the meaning of Bermuda options. Now in the exam, if this comes, please remember the diagram and write down correctly. Okay, if you are clear, type a yes in the chat box. Can I go to the next part now? Yes. Rasika agrees with my drawing skills. Thank you, Rasika. So Bermuda options are done. Let's go to the next one. The next option is called as basket options. Now, friends, tell me what is the meaning of basket? This is a basket. Normally, what do we do? Let us say I talk about Reliance S1 120. Then we talk about Reliance E1 that is going to be 100. And then we take the action as exercise. Your GP will be 20. Correct? In a basket option, I will not take Reliance alone. I will take Reliance plus Infosys plus TCS plus Tata S1. Then I will take Reliance plus Infosys plus TCS plus Tata E1, and then I will decide whether I should exercise or whether I should lapse. That is the meaning of what, friends? Basket option. So what are you doing in a basket option? You are putting everything in a basket. Is everybody clear with this part now? Type a yes in the chat box. Fantastic. So we have learnt about basket options also. Next one after basket option, next one is what you call it as a spread option. This is another crazy option, friends. Here what they will do is, let us say I'm talking about particulars. We are talking about Reliance and Infosys. First, they will take the spot price, or that is the S0. So let us say this is 150, this is 100. What is the difference between these two is what you call it as a spread. So do you get the spread as 50 over here? Same way, they will take the exercise price. Let us say the exercise price is 180. So here you get a spread of how much? 20. Now they will take this spread and they will decide upon whether they are supposed to exercise or they are supposed to lapse. So for example, tomorrow S1 of Reliance is 160, Infosys is 155. Spread is how much? 5. So you have a right to buy at 20. Outside market 5, what will you do? You will lapse. This is S1 situation 1. Now I'll give you S2, that is situation 2. Here suppose it is 160 and 100. Now you have a right to buy at 20. Outside market you can buy for 60. What will you do? You will exercise. Or basically you don't enter into S1 E1 for a particular stock, but you enter into S1 E1 for a particular spread. Is everybody clear with this part? If yes, type a yes in the chat box, my dear friends. This chapter is a beautiful chapter. All right, can I go to the next part now? So we are done with spread options also. Okay, next one. Last one is what you call it as a look back option. Look back. Friends, many of you would be having this feeling. I wish I could look back at my life and correct this, that, and that. I wish last year I had done this. I wish last year I would have done this. Friends, if you feel like that, if you are a sentimental person like that, you should take a look back option. Because what they say in look back option is that you can choose the best strike price. You can choose the best strike price in the previous given data range. So for example, let us say in the last 3 months, E1 has been 100, 120, 140. Okay. Now you see that the S1 today is turning out to be 125. So we are talking about buying a call option. So everyone tell me, I have a right to buy at 100, outside market 125. What will I do? I will exercise, I will get 25. Right to buy at 120, outside market 125. I will get 5. Here I will get 0. So which is the best strike price in this case? 100 will be the best strike price. So I would say I would take 100 and my GP will become how much? 25 rupees. This way of looking back at your life and taking a decision is what you call it as the look back option. Is everybody clear with the concept now? Type a yes in the chat box if you're clear with this part. Look back option is everybody. I think everybody is clear. Can I go to the next part now? So let us summarize. We have completed all the exotic options. What is the first one? Chooser options. Choose whether it is put or call. Compound options. After one option, another option. Barrier option. After you cross the price, you can enter into a fresh option. Binary option. When event happens, do it. Otherwise, don't do it. Asian options. Average. Okay. Bermuda options. Bridge between call and American and European. Everyone clear? Then basket options, underlying set of basket. Spread options, you take the payoff. Okay. Look back option, you look back. Then we go to the next area, which is called as credit derivative. Friends, even before I start teaching you credit derivative, let me give you a background. Tell me one fellow in this classroom who borrows money but never pays back. Whom should I catch for this example? Let me catch Prajit Prabhu. Prajit, do you ever borrow money and don't pay back? If you do that, this example is for you. Okay. Now, what is this? This is a bank. Who is this fellow? Prajit Prabhu. So, let us say the bank is giving a loan of 100 crore to Prajit Prabhu. Tomorrow, Prajit Prabhu is actually supposed to repay. Okay. This is why we use the word credit. Credit means what? The loan given. Tomorrow, if Prajit Prabhu does not repay the money back, the bank will be in soup. So what the bank does it, they normally appoint a factor. Do you remember learning factoring in your CA inter classes? Or this comes under the theory chapter of securitization, which I have covered in detail in my recorded lectures, and I'll be giving you access to all that, friends. Okay. Thank you, Rasika. Thank you so much. So like that, we'll revise. Once the whole chapter is over, I'll show you in 10 minutes we will be able to revise the whole derivatives. All right, just stay tuned. We'll be covering everything step by step. All right, yes. So friends, this thing, when the bank is appointing or giving it to somebody else, that is what comes under the category of credit derivative. So in simple terms, this credit derivative, in one way, it is nothing but an insurance. Why? If I, what is the meaning of insurance? Friend, normally insurance is also nothing but a derivative. Tell me why. What is the meaning of life insurance? Tomorrow if I die, LIC will pay me money. That is called as life insurance. Yes or no? Okay. If I die, there is an outcome. Here, what is the outcome? If Prajit Prabhu does not repay the money, bank will go bankrupt. So to protect him, they appoint a factor. Are you getting my point? So credit derivatives in one way is nothing but it is an insurance. Everybody clear with this part, friends? It is an insurance, and this is something that you actually are learning in another chapter which is called as securitization. Okay, are you clear with the background? Considering the background, can I go forward and teach you what comes under credit derivatives? Okay, I am going to the next part now. Ready? Fine. So friends, now in credit derivative, one of the way they mitigate the credit risk. What do you mean by mitigating the credit risk? Bank giving loan to Prajit Prabhu not repaying back is credit risk. Everybody clear with this part? So now we are learning about CDO, or what is the meaning of CDO? Collateralized debt obligation. CDO, collateralized debt obligation. Let me give you an example first. What is this? Bank. Bank would have given loan to multiple people. 100 crore to Prajit Prabhu. They would have paid another 50 crore to Mary's Paul. They would have paid another 50 crore to, or let us say 150 crore to, let us assume Rasiga Priya. Everybody clear with this part? So all these three will have a collateral security. Let us say the collateral security is land. Assume. Now, when I say collateralized debt obligation means these are all pooled together into one asset. Okay. This asset has collateral. Okay. And this will be transferred to whom, friends? It will be transferred to a factor. That transferring to a factor, once you do it, then you call this entire thing as what? Collateralized debt obligation. Did you understand the meaning of CDO now? Collateralized debt obligation. Okay. Now, inside CDO, you are having different types of CDO. First, you are having a cash CDO. Then, if I am not wrong, you have a synthetic CDO. Synthetic CDO. And last one, what you have is called as arbitrage CDO. Okay. So there are three types of CDO. What is the first one? Cash CDO. What is the second one? Synthetic CDO. What is the last one, friends? Arbitrage CDO. Please repeat with me. What is the first one? Cash CDO, synthetic CDO, and the last one is called as arbitrage CDO. Cash CDO, the assets are transferred to the factor. In case of synthetic CDO, friends, what happens over here is assets are not transferred, but risk is transferred. This is done using another instrument which is called as credit default swap. Okay, fine. Friends, I'll explain this once again to all of you. First, just write down arbitrage CDO objective is only to make profits. So just put this overview. We are getting into a little complicated section, friends. Just write down this overview, after which I will explain the remaining part to all of you. All right. Friends, are you all exhausted? Should I take a 5 minutes break for all of you to cool off? Razika will continue. Excellent. Others also give me your opinion. Okay. All right. Hats off to all of you, friends. Okay. So now we are learning three things. What are the three things we are learning? First one is called as cash CDO. Second one is called as what? Synthetic CDO. And the third one is called as what? Arbitrage CDO. So let us learn it one by one. Shall I start with the first one now? Cash CDO. So how the cash CDO operates is, okay, here this is the bank, correct? Bank has given, let us say, loan to multiple people, all together 100 crore. These people are not paying money. So here who is coming in? You have a factor. So what the bank will do is, bank will transfer these assets to the factor under the Surface Act. In India, you have a law called as Surface Act. All right. So now what happens? Assets are transferred from the balance sheet. Did you understand what's happening over here, friends? All the assets get transferred from the balance sheet, but these loans, okay, for example, they are secured by land and building. So tell me, friends, in that case, is it secured or unsecured? It is absolutely secured. So what the bank will do is, if these people don't pay the money, they will transfer this entire thing to a factor, tell them that you go and collect it, sell off the land, take the money, make us free from this. Like that, the bank will get its money back and the factor will be given a factoring commission. This entire process is what we call it as cash CDO. Sure, Janani, after completing derivatives, I'll give you a 15 minutes break and then we will do portfolio management. All right. It is called as cash CDO. Are you clear with the concept of cash CDO now, friends? So the definition that comes over here is, it is backed by cash market. So in my example, I told you it is land and building. It is backed by cash market, low risk weight. Why low risk? Because there is a security, relies on collateral security. What was the collateral security in our case? It was land and building. Everybody clear with this part? Next one is what you call it as synthetic CDO. That is little bit more tricky. So I'll write down the next heading in your books, that is called as synthetic CDO. So what happens in case of synthetic CDO is, here you have a bank. Bank has given a loan of 100 crore. Okay. Now here you have a factor. So now what the bank will do is, bank will not transfer, okay, no transfer of assets. No change in balance sheet. Balance sheet will remain the same. Instead, they will use something called as credit default swap. Friends, what is the meaning of swap? Shifting one fellow's loan to another fellow is what we call it as a swap. Do you remember that? So what do you mean by the word credit default swap? Credit means loan. Default means doesn't pay. So if Prajit Prabhu does not pay, then this loan will be transferred to factor. But are they transferring the whole assets? No, it will only be a off balance sheet item, the way we learned swap, friends. So since it's an off balance sheet item, what will happen in this case is that since it is an off balance sheet item, only the loss amount they will pay us back. Loss amount will be paid back to us. Did you understand this part now, friends? So what happens is, for example, they have given a loan of 100 crore. Now out of the 100 crore, Prajit Prabhu, what he has done is he has paid us 60 crore. Now what is the balance money that is supposed to be received by us? 40 crore. So bank will tell to the factor, this default is 40 crore. I want to swap this 40 crore to you. So you take up the headache of this 40 crore and collect the money. If you are able to collect the money, well and good. If you cannot collect the money, you suffer the loss. For this, what will the bank do? The bank will pay premium to the factor. So let us read the bullet points that comes in case of synthetic CDO. Credit risk is transferred. I told you the risk is transferred without the ownership of the collateral. So the collateral or land and building will lie with the bank. Instead, they create a credit default swap. So whenever the money is defaulted, only then they will swap the amount to the factor. Everybody clear with this part? So here you have three categories of synthetic CDO. What are the three categories of synthetic CDO? Unfunded CDO, fully funded CDO, partially funded CDO. So synthetic CDO has three categories. First one is called as unfunded CDO. Second one is called as fully funded CDO. Last one is called as partially funded CDO. Let me explain these points to you one by one. First, did you understand the meaning of cash CDO? Cash CDO, bank will transfer the entire assets to the factor. Security also. So completing who is taking care? The factor is taking care. In synthetic CDO, assets are not transferred. Only they enter into a credit default swap. If the fellow's credit gets defaulted, that default money will get swapped to the factor. Everybody clear with this part? But the security etc. will lie with the bank only. There is no transfer of the assets happening. Now we are talking about three types of synthetic CDO. What is the first one? Everyone tell me. Unfunded CDO. What is the second one? Fully funded CDO. What is the last one? Partially funded CDO. Everyone repeat with me. What is the first one? Unfunded, fully funded, and last one is what? Partially funded. So let us understand what these are. Let me explain to you the first one, that is called as unfunded CDO. So what happens in unfunded CDO is, you have a bank. Bank has given a loan of how many crores, friends? 100 crore. Who is this fellow? This fellow is a factor. So in unfunded CDO, factor will give a sentence: if Prajit Prabhu does not pay, whatever loss you have, I will suffer and pay to you. This is the first one. What is this? Unfunded CDO. Why it is called unfunded CDO is because this fellow, this factor, or I'll put a bullet point and write down, he only promises, full stop, he does not keep any money aside. So basically, he is only telling a promise. Tomorrow, if Prajit does not pay, I will pay you. Has he kept any money aside for this? The answer is no. But when Prajit Prabhu defaults, he will have to go to his cupboard, search how much money is there and give it over here. That is the reason this is called as unfunded CDO. Is everybody clear with the concept of unfunded CDO, friends? Please type a yes in the chat box. Okay. Second one is called as fully funded CDO. So now you would have understood what is a fully funded CDO. So what will happen is fully funded CDO is you will have a factor. Factor will create an SPV. After creating an SPV, what will they do? He will invest 100 crore in the SPV. Are you getting my point? After he invests 100 crore in the SPV, then he will go and talk to the bank. Bank would have given a loan of 100 crore over there. So now he will again tell the same sentence. If Prajit does not pay, I will suffer the loss. Now friends, not only is he giving a promise, for that promise is backed by money in SPV. Tomorrow if Prajit Prabhu does not pay, he will just take the money from here and pay it over here. So it is fully funded and backed. Fully funded and backed by SPV. This is what you call it as fully funded CDO. So friends, we learned two types of CDOs over here. What is the first one? We learned it as unfunded CDO. What is the second one that we learned now, friends? Fully funded CDO. Now tell me, if you have understood this, what will be partially funded CDO? Just give some example in the chat box. I will give you 10 seconds time. Come on, what is partially funded CDO? Friends, partially funded CDO will be earlier case, how much money he kept with him? 0. Second case, how much money he put? Complete 100 crore. Third case, he will put only 60 crore. Partially funded rather than being fully funded. So these are the three types of CDO. What is the first one? Everyone tell me. Unfunded CDO. What is the second one, friends? Fully funded CDO. What is the last one over here? Partially funded CDO. Okay, fantastic. Everybody clear with this part? So I'll just summarize this again. So we are learning about credit derivative. So basically, whenever a bank gives a loan, there is a credit. To mitigate the loss, they take some insurance. That insurance is what we call it as credit derivative. Everybody clear? Inside that, we learned about collateralized debt obligation, CDO. So you have two types of CDO that we learned so far: cash CDO, synthetic CDO. Cash CDO, there is a transfer of assets. Synthetic CDO, there is no transfer of assets. Everyone clear with this part? Next one, we learned about credit default swap. Whenever there is a default, only then they have to pay it. That payment can be done either by way of unfunded CDO, fully funded CDO, or partially funded CDO. Unfunded means he will only give a promise. When the default happens, he will take the money and give it. But we should pray to God that he has money with him at that point of time. Fully funded CDO, they create an SPV, put the money over there. Partially funded CDO, part money is put over there. Everybody clear with this part? Now, last one is what you call it as arbitrage CDO. Friends, arbitrage CDO, what I have done is, it was one of the tricky areas. So towards the end, I have given some more detailed explanation in the end. Let me take that part. Yes, synthetic CDO was a tricky concept, so I am giving it in much more detailed over here. Let us read through it. Credit risk is transferred without transfer of the assets. Are you clear? In cash CDO, assets are transferred from balance sheet. It is popular in which country? Europe. What are the type? First one, unfunded. I will pay if bank loses $100 million unfunded. Fully funded, what are they doing? Create an SPV and invest $100 million. In default, fund is transferred. Partially funded means they will not invest 100 million, maybe they will invest only $50 million. Is everybody clear with this part now? Next one is arbitrage CDO. Friends, even before I get into that, let us understand the meaning of the word arbitrage. Now to explain arbitrage, let me take a simple example. Let us talk about Sarvamangala. So friends, Sarvamangala is from Chennai. Let us say we are taking two places. We are talking about Mylapore. Yeah. Rasika, my plan was 8 o'clock to 12 o'clock. Now because I lost 1 hour because of all the net issue, I'll still take 9 to 12. I think going beyond 12, you all will be exhausted, right? We will do one more session. If it doesn't get over, I'll keep one more session and we'll wrap it up. Don't worry about that. Okay. So first one is, let us say Mylapore. Let's say another place in Chennai is Anna Nagar. Let us assume Sarvamangala goes to Mylapore to eat a dosa and the price of this dosa is 100 rupees. Then Sarvamangala will go to Anna Nagar. Same dosa is having a price of 150 rupees over there. Now tell me friends, what will Sarvamangala do? Tell me, what will Sarvamangala do? Friends, what she will do is, she will buy from Mylapore and sell at Anna Nagar. How much profit will she make over here? She will make a profit of 50 rupees. Everybody clear with this part? Now, when she goes on buying from here and she sells over here, she is going to make a profit of how much, friends? 50 rupees is the profit that she makes over here. But as she goes on buying, the demand will go up, yes or no? The price will slowly go up to 125 rupees. Am I right? Correct? Now, keep on selling over here. Supply will go up. When the supply goes up, the price will fall to 125. And in the long run, so what happens over here, friends? In the long run, Sarvamangala cannot make arbitrage profit. Okay, so I'll repeat this part, friends. Rasika, you are saying she will eat in Mylapore. Eating is not the objective here. Here the objective is to make profits. Are you understanding my point? So basically what happens is, when she keeps on buying at Mylapore at 100, demand goes up, price goes up. Keep on selling at 150, supply goes up, price falls down. In the long run, both will be the same. So in that short term, that difference is what profit that you make over here. And this short term profit is what we call it as arbitrage. So friends, are you clear with the concept of arbitrage right now? Are you all clear with the concept of arbitrage? Yes. So if you are clear with the concept of arbitrage, let me go to the next part now, friends. Okay. So here, what they are trying to do is, they buy low, sell high. What did Sarvamangala do over here? Just check. She bought at 100, sold at 150. Am I right? So same way, what these people are doing is, now the bank or whoever is entering into this kind of arbitrage CDO, in simple term, what they'll do is, now this is a bank. So bank can lend at, let us say, 12% to a customer. Correct? Bank can borrow from some other people at, let us say, 8%. Okay. So what did the bank do over here? The bank borrowed cheap and lent at higher rate. By doing so, the bank is making a profit. This profit making mechanism is what you call it as arbitrage CDO. Everybody clear? So you raise debt at lower rate and invest at a higher rate. That difference is what you call it as arbitrage CDO. Are you all clear with this part, friends? Please type a yes in the chat box. Alright friends, I think we'll take a short 10 minutes break now itself. And I think in this YouTube also there is some ads are coming in between. So I think I'll just set up a new account where I can do it without ads. I don't know why ads are coming in. So that it can be much more seamless for all of you. Yeah. Alright. So we'll take a short break, friends. I'm ending my stream over here. Okay. So we'll do one more derivative part 2. I think there's still more to learn over here. We have to learn about next. I think we are done only till credit derivatives, right? CDO is done. Yeah, let's just complete this part, friends. Just 1 minute. We'll complete this part, then I'll give you a break. Okay. So I think they buy cheap and they invest high, and to manage this money they charge a commission that is called as arbitrage CDO. Okay. Yes, Rasika, I am removing it. I'm not sure why those ads came in. I did not set it up. Something wrong with the settings. I will after the new edition. You will not have that ads coming in. So now tell me, friends, what are the risk in CDO? First one is called as default risk. What do you mean by default risk? You give a loan, okay? You give a loan to somebody else and they don't pay the money. Default risk. Interest rate risk. What do you mean by interest rate? What do you mean by interest rate risk? So basically, interest rate risk means whenever you give a loan, if the interest falls down, you make a loss over there. Liquidity risk. I have given loan, my customer does not have liquidity, so he's not repaying the money back. Risk. Prepayment risk. That fellow pays me in advance. Because he paid me in advance, I was supposed to get some interest. Now I am not getting prepayment risk. Reinvestment risk. I gave a loan at 12%. I got back my money. Now when I am investing it back, I am getting only 10%. Reinvestment risk. Forex risk. So now what is happening is, now you export. I am getting in dollars. Dollar fluctuates, my money goes. Foreign exchange risk. These are the risks involved in CDO. So what are the risks? Everyone tell me. Default risk, interest rate risk, liquidity risk, prepayment risk, reinvestment risk, and what is the last one? Forex risk. Is everybody clear with this part? Okay. Now, credit default swap. We have also learnt about credit default swap. Am I right? So here it is insurance, as I told you, against the risk of default. Buyer will pay premium, who will take default risk. So all that synthetic CDO, cash CDO, etc. is all, it's all nothing but credit default swap. So what are the features of credit default swap? They are non-standardized. So why do we call it as non-standardized? Mainly because when you go for credit default swap, you don't have any standard rules. You can do it however you want. It is not traded on exchanges. ISDA, I forgot the full form. International Swaps and Derivative Association. Okay. ISDA has given some guidelines. Ideally, when the risk is more, the premium will be more. Are you all clear with this part, friends? Yeah, Rasika, if he pays soon, we get money soon. If he pays soon, you get money soon, but he was giving you 12% rate of interest. Now you are putting that money in some other instrument, there you are getting only 10%. How much loss did you make? 2%. Had he kept on paying me, I would have got this 2% more. Losing that money is what you call it as a credit interest rate risk or reinvestment risk. Are you all clear with this part? So friends, I think we are done with session 1. Shall we take a break now? We've learned quite a lot of things. We have spent 2 hours learning all this. Okay. Let's take a break now. Okay. I'll see you after 10 to 15 minutes of time. Thank you, friends. We'll finish off derivatives today and then we'll keep one more session for portfolio and security valuation. All right. Thank you.